Welcome. I'm Catherine Magana here with Rachel Ivanovich from WWM Financial. And today we wanted to have a webinar on the One Big Beautiful Bill Act and what investors need to know. We know there's a lot to cover. We're going to talk about taxes, a lot about taxes. We're going to talk a little bit about investments and some planning ideas. And our hope is after today you have some ideas and we're happy to collaborate with you and see how this fits into your current situation. And so one of the things that we do at WWM Financial is we do offer our proactive wealth process, which each quarter we pick different themes and topics that we think is educational for our clients. So throughout the year, we host different webinars. The topics are on asset management, liability management, protective strategies, and estate planning. So in the past, we've done a webinar on mega backdoor Roth IRAs. We've also done Social Security strategies, as well as navigating required minimum distributions. And today we're focusing on the One Big Beautiful Bill Act. So once again, thank you for joining us, and let's go ahead and dig in. So I'm one of the managing partners here at WWM Financial. I serve as a certified financial planner professional. I have been in the financial services and financial planning profession for over 26 and a half years. And over that time, I've seen a lot of rules and changes. And obviously, that's one of the reasons why we're on here today, is to kind of talk about some of the changes that are in place. I'm very active in the community. I serve on a few boards, as well as have participated in the Financial Planning Association of San Diego and California. And it's an honor for me to be here with you today.
And I'm Rachel Ivanovich. I am an enrolled agent, and I have an MBA in finance. I have been working as a tax professional now for 25 years, just finishing up my 25th tax season. As Catherine said, I have seen a lot of changes in the industry and many tax acts come and go. So excited to talk to you a little bit today about the tax changes that are coming up and the things that have already been rolled out.
And so the bill got signed on July 4th, so that was something that was talked about a lot this year. Finally, the legislation bill was signed on July 4th, and now we're navigating through that to see what the changes and how that's going to impact you. With that, there's been tax policy changes to energy, defense, and some social programs. As well as potentially with some of these changes in the tax code, we are potentially going to see, or there's talks that we're going to see a $5 trillion increase to the debt ceiling. So those are some things, some big numbers, but some of these cuts do benefit some and it doesn't benefit others. But we're going to talk through all of that with you today. So a few key points or a few areas that we wanted to highlight are the permanent extension of the 2017 Tax Cuts and Jobs Act. The individual rates are keeping at the 37% rate. Also, there's the standard deduction that doubled and is indexed for inflation. We're going to go over the SALT deduction cap, which was raised to $40,000 for 5 years, and the pass-through income deduction at 20%, which was made permanent. And then the 100% immediate expensing for some business opportunities for small business. And then we're going to touch on some deductions for tips, overtime, U.S. man-made auto loan interest, and senior deductions. And so I'm going to turn it over to Rachel. Rachel's our tax expert here, and she's going to cover all of this a little bit more in detail, as well as some other tax code that you should be aware of.
Thanks, Catherine. And the first thing that I wanted to touch on is what permanent actually means, because permanent really just means until the next administration gets elected. So let's just jump in here and talk about this today. So some of the big basic changes are to the tax rate. So the Tax Cuts and Jobs Act was enacted at the end of 2017. It reduced the tax rates, and it was only supposed to be until until the end of this year, 2025. And so this new law, that the One Big Beautiful Bill Act, has made those lower tax brackets and rates permanent. Again, permanent means until the next administration makes them, changes them. The standard deduction back in 2017, at the end of 2017, it was much lower. It was doubled under the Tax Cuts and Jobs Act, and therefore they have now made that permanent. One of the other things that happened under the Tax Cuts and Jobs Act was there used to be something that everybody got, which was a personal exemption amount. And so that personal exemption was about $4,000, and that was temporarily put in place, quote unquote eliminated back in 2017 for 2018 taxes. They have made that permanent under the under the One Big Beautiful Bill Act. So you're no longer getting that $4,000 exemption. And what an exemption means is basically $4,000 that would not have been taxed per individual in your household. The exception to this is the new personal exemption for seniors. So seniors, let's define that. So that means individuals over age 65. And if you are married filing separately, this doesn't apply to you. This is only for 2025 through 2028. And if your income is over 75,000 and you're single, the exemption is eliminated. If your income is over 150,000 and you're married filing a joint return, it's also eliminated. So one of the things to keep in mind is it is an exemption. It's not an increase of the standard deduction. So if you don't itemize, you still get that full standard deduction plus that exemption amount. So wanted to clarify that. Some of the other changes, and this was the one big change that so many people were talking about, that is the state and local tax deduction, or the SALT deduction. And so this is a deduction that for people in higher income states, or states where property taxes are very high, that they definitely felt the pinch of this. So this was first enacted under the Tax Cuts and Jobs Act in 2017, and it basically put a cap on what you could deduct if you itemized. And previous to Tax Cuts and Jobs Act, you could deduct all of your state taxes, all of your local taxes. This is like your car registrations, and then also your property taxes. So if you had multiple homes, vacation homes, not rentals, because that's a different picture, but there was a cap put on that of $10,000. So under the One Big Beautiful Bill Act, this has been temporarily increased from $10,000 to $40,000 for 5 years. So it reverts back to the $10,000 cap in 2030. And a lot of people have asked, so if I'm married, do I get $80,000? And the answer is no, you only get $40,000 if you're single or married. So there is a little bit of a built-in marriage penalty there, unfortunately. And it does phase down. What this means is if your income is over a certain dollar amount, and I believe it's about $500,000 for 2025 returns, it incrementally, that $40,000 gets smaller and smaller and smaller until you hit the $10,000, and then that's where you stay. So it can't go below the $10,000 cap, but if your income's too high, you don't get the full $40,000. So the state and local tax deduction, it is indexed by 1% each year from 2026 through 2029. And one of the big questions we get from our business owners is, the last few years, specifically from 2018 through current, the states came up with a workaround, or a loophole, kind of, let's call it a loophole, sure, to the cap on the state taxes. And so this cap basically, it was in place. The state said, well, what if you are a business owner, and what if then you could pay your state taxes through your corporation, which is a pass-through entity. So maybe you're a partnership, maybe you have an LLC, an S corporation. You could pay the taxes through that business entity, deduct it for federal purposes, so your taxable income comes down, and then the taxes become a credit on your state return to pay your taxes over there. And so the tax professional community really wanted to know, so if this cap, the state and local tax deduction cap, goes up, can we still use this workaround? And the answer is yes. So this is a big win for business owners. Some of the other deductions that were made permanent under the One Big Beautiful Bill Act is the mortgage interest deduction. So in 2017, Tax Cuts and Jobs Act reduced the amount of mortgage interest that you could deduct. It used to be on loans up to $1 million and then $100,000 of home equity debt. You could take the interest on those. It was first and second home. Unfortunately, they reduced that to $750 under the Tax Cuts and Jobs Act, and the One Big Beautiful Bill Act did make that permanent. So if you have a loan that's over $750,000, some of your mortgage interest won't be deductible. If you have multiple homes and some of them are investment properties, you still can deduct that interest on the investment properties. So just keep in mind, we're talking about itemized deductions here, not on investment or rentals. So rental properties, you still can deduct all of your property taxes. For rentals, you still can deduct all your mortgage interest. A new old thing, so mortgage insurance premiums can be deducted again starting in 2026. Which that used to be in place in, I believe, in 2018, 2019, and that's coming back for 2026. Another thing that's going to be increase our educator expenses, so it is a win for teachers. If you know any teachers, let them know. Make sure they're saving all the receipts right now, because they can deduct $300 above the line, meaning it doesn't have to be part of itemized deductions. And now, instead of it being a miscellaneous itemized deductions, which basically got eliminated under the Tax Cuts and Jobs Act, it becomes an additional deduction under this new bill. So that's definitely a win for teachers who are taking care of our young people. The other thing that was put in place is gambling losses. If you love going to the casino, unfortunately, gambling losses previously, you could deduct your gambling losses up to the extent of your winnings. Right now, they're limited to 90% of winnings. So they do get a haircut now under this new bill. And one of the things that is coming back that has been eliminated for about 8 years now is, it used to be called the P's limitation. And what that is itemized deductions. If your income is over a certain dollar amount, you can't deduct all of your itemized deductions. It gets basically a haircut. So this is a planning opportunity if you are in the 37% bracket, which is the highest bracket. You want to work with your advisors, work with us to make sure that we bring your income down by either pushing income out or accelerating deductions to get you into the 35% bracket so you don't lose any of your itemized deductions. Charitable contributions, there's some wins and some losses here. So we've got, starting in 2026, I believe there's a deduction for, I think it may actually be in 2025 for non-itemizers. So basically back in COVID, 2020-21, there was what we call an above the line deduction, meaning even if you don't itemize your deductions, you still can deduct your cash contributions to charity. And cash defined as debit card, it's not writing checks, if you pay online, just not non-cash, meaning clothing or furniture. So if starting, this, I believe it's this year, it's $1,000 per taxpayer. If you're married, it's $2,000 for cash contributions. So definitely think about what charities you'd love to give money to, because that will be a benefit on your taxes. Starting in 2026, though, for charitable contributions, they're instituting what they're calling a 0.5% floor. So it's adjusted gross income. And this is similar to medical expenses. And a lot of clients always ask, can I deduct my medical expenses? Do I have enough in medical to actually deduct this? And so medical expenses get a 7.5% haircut. And so this is basically, you look at what your adjusted gross income is, you take half of 1% of that, and then that you have to subtract that off whatever your charity is. And that starts in 2026. So we definitely want to be planning this year. And if you haven't given yet to charity, definitely talk to your advisor, call us, we'll talk to you about it, because that is a new, it's a new floor that's going to be put in. Something that's kind of fun and exciting, I talked about it on the podcast a couple of weeks ago, is starting in 2027, there's going to be a new tax credit for any charitable contributions that are to certain scholarship granting organizations, and you basically will qualify for a tax credit of up to $1,700 per taxpayer. So if you know of any educational institutions that you would love to give money to, maybe you have your favorite alma mater, they grant scholarships, you may qualify for a tax credit of up to $1,700. And I do believe this is for married folks that you can double that. So just some kind of 2 tax planning tips when it comes to charitable contributions. Make sure you're making larger charitable contributions in 2025 to avoid that 0.5% floor that starts in 2026. And then you also may consider in the future, if you're over 70 and a half, you can actually make or do a qualified charitable distribution from your IRA. And basically what this is so if you're over 73, you have to start taking money, required minimums out of your IRAs. But instead of having the money come to you and it being taxed on it, you can send it directly to your favorite charity. You don't get tax on it, they get the benefit of it, and it's kind of a win-win. So that's not subject to the 0.5% floor. So just something to think about in the future is plan with us. We'd love to talk to you a little bit more about qualified charitable distributions. So I'm going to give it back to Catherine. All right, Catherine, take it away.
Okay, so looks like
I think this is one more slide for me, isn't this?
Yes.
Unless you want to talk about
No,
no tax.
go ahead, it's all you.
Okay, all right, so we do have under the One Big Beautiful Bill Act, we do have a couple of those campaign promises that that Trump talked about. These are new above the line deductions. So it is a little bit misleading when we talk about no tax on tips or no tax on overtime. But basically what this means is if you have a job where you receive tips or you have a job where you're receiving overtime, there's certain dollar amounts that will be deducted out of your adjusted gross income. So let's say for you're going to get your W-2, all of the income is actually still going to show up on there, but you're going to be able to take a deduction for tips of $12,500. And this is only from 2025 through 2028. And then also for overtime there, and it is per spouse. So it's not just, so for instance, if both you and your spouse receive tips, you each can deduct up to $12,500 from your income. And there's going to be a lot of guidance that's still coming out. So just stay tuned for that. There's a kind of a fun new one. This is a deduction for qualified car loan interest. And basically this is going to be what they call an above the line deduction, meaning you don't have to itemize to qualify for this deduction. And so it's on loans starting in 2025. It's up to $10,000 of loan interest paid, and you get to deduct that off of your taxes. So just keep in mind the final assembly for this vehicle must occur in the United States, and it does have to be a brand new vehicle. But wait, there's more. There's a new pet deduction, but unfortunately not. So talk to your representative. We were really hoping for this one, but unfortunately we still can't write off our pets. So just a couple of other things to look at, other Tax Cuts and Jobs Act extenders. So we have in 2017 or prior, you could deduct, if you moved out of state, you could deduct your moving expenses. A lot of clients have been moving, downsizing, moving to be closer to their kids, and you used to be able to write these expenses off. Unfortunately, the deduction has been made permanent. You can no longer write off moving expenses. There are a couple of exceptions to that rule if you're active duty military, or I believe if you're in entertainment business or something. So it's just very specific to a couple of industries. And then there has been a permanent suspension of the 2% miscellaneous itemized deductions. So basically, this is a category of itemized deductions such as your tax preparation fees, your investment fees. You can still deduct those for state purposes in a lot of states, but federal, they did make it permanent. You can't deduct those. And there are little tricky ways to get around that. For instance, if you have partnerships, you could take it as an unreimbursed partner expense. If you have rental properties, we could deduct it as a rental property expense. If you have a business, we write it off through your business. So there's definitely ways around this permanent suspension. And the other thing with miscellaneous itemized deductions, that 2% category, is home offices. So if you were a W-2 employee and you have a home office, a lot of people are working remote. We are really hoping for this deduction. Unfortunately, they did make it permanent that no longer you can't write off home offices if you're a W-2. If you own a business, it's really different for you. So keep in mind, you definitely want to talk to us. We can walk through your individual situation because it's not a one size fits all sort of situation. So let's see, I believe it's Catherine's turn, but nope, I guess it's got one more slide. So there are the increased credits and some eliminated credits under the One Big Beautiful Bill Act. So the child tax credit was made, was increased under the Tax Cuts and Jobs Act up to $2,000 per child, and it now will be $2,200. The child and dependent care tax credit has also increased, so you can write off more daycare, or your children who have, so they can write off more daycare. The two credits that you need to be aware of that, and you need to plan for now, are the electric vehicle credit. It's going to be eliminated as of September 30th of this year. And so if you are thinking about getting an electric vehicle, time to act is right now. You've got about another month to do that. I actually had a call with a client yesterday who was looking at leasing an electric vehicle. They went and met with the dealership, and the dealership is getting the $7,500 credit. So they subtracted that off of the leasing price, and it reduced their lease payment. So you don't actually get the credit if you lease a vehicle, but it does affect your overall payment if you're leasing. So just keep in mind that's going to be gone in about a month. With solar credit, this has been around for a few years. It's a 30% credit and there's no income limitations on it. Basically, whatever the cost of the purchase and installation of solar panels, and also charging in your, let's say you have an electric vehicle and you have a charger in your garage, the cost of that purchase and installation, there is a 30% credit available, and that is, the credits are dollar for dollar reduction of tax. These are valuable. So these are going to be gone as of the end of the year. So the time to act is right now if you want to take advantage of that solar credit. So you better get on it and talk to your solar installation, because I'm sure guy or gal, because they're going to be pretty busy, I think, coming up soon. One more slide. Business deductions. If you have a business, this is a great time to invest in equipment, and because 100% bonus depreciation has been reinstated. This was enacted under the Tax Cuts and Jobs Act, which basically what this means is if you purchase any equipment for your business, you can write that off, and it's accelerated depreciation, so you can write off the entire cost of it in the year that you purchase it, therefore reducing your overall taxable income. There are also expensing limits that have gone up, and I think this is a great time to really be thinking about, what do I need for my business? How can I reduce my taxes overall? You do need to keep in mind that the 100% bonus depreciation and the increased expensing limits, it's on property and assets purchased after January 19th of 2025. So if you bought something the first couple weeks of the year, it doesn't qualify. And the good news with this is used property does qualify. So for instance, if you bought a used vehicle for your business, it does still qualify for that bonus depreciation. In the past, oftentimes they put limitations on that if you bought a used vehicle, you couldn't write it off, or you couldn't get the full bonus. You could write it off, you just didn't get the full bonus on it. So like I said, it's a great time to invest in equipment for your business. Make sure you're talking to us about what you can write off. We'd love to help you understand your taxes. I know it's a lot right now, but we definitely want to talk to you about your individual situation. And so now it's Catherine's turn.
Yes. All right. Thank you, Rachel. I know that was a lot to cover, with a lot of detail, and it seems like there's more and more information coming out every day too. So
yes.
Okay, so let's talk a little bit about sectors. First, fossil fuels. With the act, it opened up more public land to drilling and lowers royalty costs. So with that, that means it's a good opportunity, or there's tailwinds for oil and gas producers. Second, we have defense and aerospace. So the bill allocates $150 billion in new defense spending, plus additional funding for NASA's lunar and Mars missions. So this is good news for those contractors and aerospace suppliers. Third, there's small business and manufacturing. So with some of the, like Rachel just went over, some of the additional expenses and depreciation, there's more incentives then for companies to kind of reinvest back into their businesses. So those are kind of some areas that sectors that have kind of benefited, potentially could benefit from this act. Some of the, on the other side, some of the losers are the clean energy and EVs. I know that Rachel just kind of went over some of those phase out and deadlines. So the tax credits from the Inflation Reduction Act are being phased out. And so obviously this will change those that are, you know, once again, I think like Rachel mentioned, you have a client that's in there right now trying to make sure they take advantage of this, but going forward, it's going to change. I say health providers and state governments also take a hit. So with the largest Medicaid cuts in history, that puts pressures on hospitals, insurers, and social programs, but it also affects some of those that are currently getting those benefits. And so basically there are, you know, those that are, you know, winners and losers from this act. And I guess the takeaway from this is potential sector rotation, looking at the energy and defense are areas that are benefiting, and then some of the clean tech and healthcare potentially are facing some challenges with these changes. So once again, this is something, if you're invested, you might have, there might be different portfolios you're invested in, so potentially there could be certain investments that are tied to this, even with exchange traded funds or mutual funds, or just know. So this, depending on how you're invested, this could impact you. And once again, we're happy to have that conversation with you individually. All right, so Rachel, do you want to go ahead and move this screen forward for us? And so some of the economic and fiscal impacts from this, so basically the consumer discretionary, I'm sorry, the consumer budget office is, I'm sorry, Congressional Budget Office is estimating $2.8 to $3.8 trillion over the next 10 years would be the impact. And looking at, well, this does provide tax relief for some. Roughly 70% of the tax savings does go to the top 20% of households. And regarding Social Security, it looks like potential insolvency accelerates by 1 year. So what that means is currently it's on track for 2034, and now we're looking at 2033. However, that's a whole another discussion. I know there's different talks and things that we've heard about, you know, would they increase the age? Are they going to change the payroll tax or the limits? And so that could change over time, and that's a whole other conversation. But at this point, you know, they're looking at that changing by a year. And then the insurance coverage. So there's 10 to 12 million people projected to lose coverage. So obviously, that's a big impact in making sure, you know, how does that tie into your financial situation and your budget. And then once again, going back to the Social Security, once again, potentially those changes could affect, or another thing we've heard is, you know, are they going to reduce the amount of the benefits is another option. But once again, hasn't been concrete. That's just something that's been on the table that we've heard over the years. Okay, and then, so the other part we wanted to go over is the estate and gift tax exclusion. And so the amount for 2026 is now $15 million per individual, or $30 million as a couple, and that's effective January 1st of 2026. It is indexed for inflation, so starting in 2027, that will be indexed for inflation. The estimated tax remains at 40%, and the estimated estate tax rate remains at 40%. And then currently the annual gift tax exemption is $19,000 per person, or $38,000, if you're married, for each for each spouse to give to a designated beneficiary. The other thing that comes up, and Rachel probably can contest to this, is if you decide to give more than $19,000 per year, or as a couple, the $38,000, you can do that. It's just you have to file a gift tax return, and then so it's something that can be done. I think sometimes investors feel that, oh, I can't give more, but you can. It's just making sure everything's documented.
And do you mind if I jump in really quick?
Yeah.
Because I had a situation with a client just the other day where, so that is absolutely right. And what's interesting is you need to be really careful with this because, for instance, so it's a husband, wife, and they're younger, they're in their 40s, and then mom and dad who are in their 60s. And mom and dad lived in the house, and they decided the daughter and her husband decided to move in with mom and dad to save money. And then they gave mom and dad $100,000 to pay off the house. So that was a gift. And so the question is, how do you structure this? Because you've got $100,000, and all of a sudden, it's depending on how you do it, you actually could have that $19,000 times 4, meaning you've got that exclusion. So from son-in-law to father-in-law, that's $19,000, son-in-law to mother-in-law, that's $19,000, and then daughter to mom and daughter to dad. So you've got all of those, and so all of a sudden we have to file multiple gift tax returns, but we ended up only having to, instead of having it be 83,000, so you do the 100,000 minus, it's 18,000 this last year. So the way that the gift tax works is you don't pay tax on it right now, but it reduces your overall lifetime exclusion amount. So if you structure it properly, you can actually maintain more money that can be excluded later on. And what we were actually talking about is how important it was to actually write, even though it's annoying to have to write 4 different separate checks, making 4 checks for that 19,000 and then writing the difference so that it's very clean when you file those gift tax returns. So if you're thinking about gifting, make sure you ask us, because there are some specific ways that later down the line it will save your loved ones money.
Okay, I think I'll turn it back over to you, Rachel.
All right, so one of the things that you have to keep in mind is just because the federal government has passed this One Big Beautiful Bill Act, that doesn't mean that your state conforms. And so you definitely want to check in with us to make sure, does this apply to my state? Do I still get the deduction for my state purposes? Even though federal is giving it to me, it doesn't necessarily mean that the state will give it to you. Oftentimes, there are many states that will take it away, even though you get it for the federal purposes. So we give up. There's so many tax changes. What are we going to do? What can I do right now to prepare for next year? And our advice to you is to really reach out to your wealth advisor. Reach out to us, talk to your estate planning attorney and your tax professional, because each situation is unique, and you definitely want to be checking in now. There's still a few months left in the year to do some planning to make sure that you're saving as much as you can and not giving the government any more money than you have to. So if you have any questions, we would love it if you'd reach out to us and or schedule an individual consult. So Catherine, back to you.
Yeah, so we know this One Big Beautiful Bill Act, there's a lot of information, a lot of detail. There are some tax planning opportunities, investment opportunities. Like Rachel mentioned, we're happy to revisit your personal financial plan, investment proposal, and talk about how this impacts you directly. And so please feel free to reach out to us. I'm happy to set up a Zoom, phone call, or in-person meeting. And we hope you learned something new today. We know there was a lot to uncover. And once again, we're happy to be a resource and see how this impacts you individually. So that concludes today's presentation. We do appreciate you taking time out of your busy lives to be with us here today. If you'd like to reach us directly, you can call our office at 760-692-5190, or feel free to email us anytime, and we're happy to set up a time. So once again, thank you for joining us, and until next time, we'll see you then. Thank you.